Hello everyone, this is Fotis from Fotis Trading Academy. In previous videos, we discussed price action. Allow me to remind you, we started with a larger time frame and we first explained some basic topics about resistance and support. We said how we move from a higher time frame, we are looking at points where it is more likely the buyers and the sellers are going to be interested. We showed you how to find those levels and then how we move to smaller time frames so we can find good entry points. In another video, we told you how to identify those key levels by combining support and resistance together with technical indicators. For example, right here we gave an example with the moving average on a daily chart and using an oscillator. There are certain indicators that will work very well when the market is trending either upwards or downwards, and there are other indicators that will perform very well when the market is moving sideways, and those are usually the oscillators. Allow me to move to an even smaller time frame and show you something. Let's move to something like this without any indicators. This is the daily. Let's switch to an hourly and zoom out a little bit so you can see what is going on. And I'm going to move this so you can see the bigger chart. So this is the Euro USD 1 hour. What do you notice? If you are trading price action, everyone is going to have a different opinion about what is going on. Some people will say, oh, we see a resistance. Where? We see a resistance right there. This is why you have to be selling here. Another one will say, oh no, actually we had a breakout. We had a resistance to the downside. It broke up and this is your entry. Another one will say, well, the trend has changed to the other direction and we are supposed to buy on pullbacks. My point is, there is no correct or wrong answer. Each one of us, each trader, is going to have a different opinion about market structure. The point is, when do you have a conviction that you are correct? When can you have a conviction that you have an edge? And this is why I'm going to discuss today why some traders are using technical indicators so they can have a more disciplined approach. So it is not completely discretionary what is going on, but they have a more systematic and disciplined approach. So I'm going to delete the trend lines. We do not need those anymore, and I will switch back to daily. So allow me to say what was happening in the 80s towards the 90s, how people used to trade, because you will see there is a natural evolvement. So for example, I will press F11, let me remove this, and I will go here to trending indicators. So people back in the 90s, 80s, 90s, they would use, of course, the moving averages. If this is the daily, most likely they would be using, let's say, a 21. Let's use a blue one and switch to this. So there you go. This is the 21-day moving average. And in some cases, they would even use a second moving average of a larger time frame. So for example, let's use the 63 because it corresponds to a quarter. And then a third one, but I think that's enough. And how would people trade? Let's press F11. They would look for the breakout. They would say something like, oh, look, the fast MA has broken above the slow MA, so here we have an entry, we have to buy, or here we have a break to the downside, we have to sell. Over the years, this evolved. So they started approaching this from another perspective. If we have a bullish breakout, then they would say, oh, okay, let's try to buy on a pullback as close to the MA as possible, all the way to the upside. And why would they do this? Because they would get a better edge, they would get a better reward to risk. And they would do the same on the downside. They would say, since we have over here a bearish breakout, let's sell as close as possible to the resistance, as close to the moving average as possible. Then in the 90s, towards the 90s, there was another approach. They used also oscillators. So let me apply the MACD with whatever settings it is built. And we will also use another oscillator such as the stochastic. So I will just click reset. And they would do something like this. So let me zoom out so you will see. They would say, right, we have a bullish breakout, we have another confirmation that the MACD is positive, is breaking above the zero line. So this is a clear buy. Or here the opposite happens. We have a breakout to the downside, the MACD is below zero, we sell. They would use the stochastic on a pullback. So if the trend is positive and the MACD is above zero, they would buy on pullbacks of the stochastic all the way up as long as the trend is moving in their direction. And they would sell, if they were sellers, they would sell when the stochastic is up since the trend is moving downwards. And from this, in the 90s, we had the popular Bill Williams strategy. From a popular trader, he wrote a book called Trading Chaos, and he introduced the alligator. So over here you see in MetaTrader, we are talking specifically about Bill Williams. Let me remove these moving averages and you will see what is the Bill Williams system. So Bill Williams used three, as you can see here, he used three moving averages. It doesn't matter the settings right now, but he used three moving averages and he called them the alligator. He used the awesome oscillator, which is nothing but a MACD, and he used also this, the accelerator oscillator, and he used the fractals. What is the fractal? The fractal is the higher high and the lowest low of the last three bars. So let me click F11 and show you how people used to trade back then and how this system was used, that was introduced first by Bill Williams. But the principles were already there, it was not something new. This is how the system would work that was introduced by Bill Williams. Is the price above the alligator and the moving averages are moving upwards? Is the fast above the slow one? Yes. Then okay, this is step number one. Step number two, is the awesome oscillator green and rising and above zero? Yes. Is the oscillator green and rising and above zero? Yes. Then place an order to buy above the latest fractal high, which is there, and place the stop below the lowest fractal low. And that was your entry for a long. Your entry for a short would be the opposite. A short order would be the opposite. Is the price below the alligator? Yes. Do we have a break of the previous fractal low? Yes. Then that's your entry. Stop above. You need to confirm that the awesome oscillator is below zero and red. And we have also the accelerator is also in the red. So this is your entry, stop above all the way down. Now you might be looking at this and think, wow, this is fantastic. Why don't we trade like this? Because in the 90s we had very strong trends. Now I have cherry picked this chart. But there are periods, let me get rid of the auto scroll so I can show you. There are periods that there is no trend. So here is a trend. But what happens when you have something like this? You will get lots of choppiness. You will get false entries. Or this area right here. Where is your entry? So, or here, don't think that just because of a certain period has worked well, that this system will work well for every single time. Every system has its limitations. So whatever combinations you decide to do, maybe it's a combination of moving averages, maybe you use some other indicators, maybe it is support and resistance. It is certain that it will work very well during certain periods, but in other periods it will not. For example, here in this interval, Well, it doesn't work really well. Or look at this. This is why we say whatever you decide to do, have an understanding about what is going on in the markets. But I just wanted to emphasize here why sometimes people are using technical indicators. They are using technical indicators so they can have a more systematic, a more disciplined approach. And of course, you can do the same on a smaller time frame. The same principles apply on a smaller time frame. Be prepared that in a smaller time frame you will get more signals and more noise. But what you can do is potentially you can combine the signals from the technical indicators together with support and resistance. So this is the way that people used to trade in the 90s, and now as we moved after the year 2000 and we are now in 2023, of course there are other indicators. We have more advanced moving averages. We have ATR based indicators. Allow me to show you a couple. So I'll just press F11, go to my list of indicators. I will use something like this, color line. So you can see here, this indicator is based on the volatility to provide the entry. So you buy when we have a breakout to the upside, and you sell when we have a breakout of the uptrend. Pretty straightforward. I think you get this. And again, you can also combine this. These kind of indicators were working miracles back in the 90s. There were people that made millions because of this. But these days, I can tell you this, that especially after 2008 with the great financial crisis, as soon as central banks took over from the markets, as soon as central banks took over from Wall Street, it is a very different environment. It is more choppy. The very strong macro trends of the past are gone. And I haven't seen a single strategy that works well in every single environment. What worked well for 22 doesn't in 23, and perhaps what works in 23 will not work so well in 24. The secret to your success is not how you use support and resistance. It's not only how you combine the technical indicators. What you need to do in order to be a successful trader is to start understanding the narrative, what is happening, and in the next video, I'm going to show you a complete approach. I'm going to show you a framework where you do use technical analysis, you do use indicators, but you are adding a secret sauce, let me say, that will completely transform your results. But I'm going to share all these secrets in the next video, so stay tuned.